How's it going, everybody? My name is Antonio, and what you're about to watch or listen to right now was actually supposed to be just a quick, short 15-minute talk with Rick Rowe for the weekly market overview that I do. Shout out to that, I guess. But we kept talking for over about an hour or so, and it turned out into its own podcast. I thought so. I thought that I'd edit it and publish the whole thing immediately. So we talked yesterday on July 29th. And so, yeah, this is just the whole thing because we really talked about a lot of important and interesting things. We talked about Robert Friedland and sort of his takes and predictions on copper as someone who's very biased, obviously, towards copper himself. We talked about the Lundins and what they are doing with the Vicuña district. We talked about gold, inflation, central banks, and all these things, of course, the whole shebang. But I also got to finally ask Rick about the Physical Uranium Trust, the Sprott Physical Uranium Trust, and what's going on with that discount to NAV that's now been going on for quite a while, as well as what he would do differently if he was running the show. He also gave me his opinion on the other physical funds in uranium. So it was his answer was interesting, to say the least. And we even talked about mining the moon for some reason. He even said a few things about central bank digital currencies and stuff like that. So yeah, here's the whole thing. I don't know why I'm explaining it, but watch it, like it, share it, tweet it, Snapchat it, or don't, maybe. Whatever it is that kids do these days. I don't know, but here's Rick Rowe. All right, Rick, it's been about a month or so since we last spoke. I know the audience has missed you, and they've missed hearing about copper, I believe. And copper is having a bad week and a bad month, and it seems like it's all about a bad year, actually. I think it seems like it's all about China right now. Generally, how the narrative has went over the last year, almost 2 years now, I guess, is that China would come out of lockdown, swinging big stimuli, and it'll rocket copper demand. So the price rose in sort of anticipation of that. And then when those measures disappointed, copper fell, has been falling consistently, as I said, now over a year. But then this week, we saw some moves coming out of China where like Development and Reform Commission is basically pushing banks to write out more loans to manufacturing companies specifically. But copper is still falling. And at the same time, though, we have one of your better friends causing mayhem out there. Robert Friedland has gone out there and warned of a copper supply train wreck, is what he calls it. And so on one side, I understand that it's sort of like the cake maker saying that cake is very good and healthy for you. But what's happening with copper? I said a lot there, but maybe you can take it away and tell me what you make of it.
Well, you did say a lot, so I'll try and unpack it to the best of my 70-year-old memory. Let's work back with Robert. As you point out, he is a good friend of mine, and he is a good friend of mine, among other things, because he made my clients, when I was actively employed in financial services, hundreds of millions of dollars. If you really want to lock in a commercial friendship with me, you do it by performance, and Robert did. He is, of course, the best salesman that I ever met. He outpolls me at my own conference as best speaker, and I'm not a bad competitor in that regard. Robert is very flamboyant, but he is also very, very often right. When you talk about the copper market in conjunction with China, it's interesting to note that the people that are concerned about near-term fluctuations in the copper price concerning China don't include China. The Chinese, through Robert, among others, are investing literally billions of dollars in developing copper supplies for the continued urbanization of China. In the very near term, I think what you're seeing is the type of weakness in global construction that you would anticipate given the weakness in commercial real estate, as an example, in North America and Europe and China. You are seeing, too, dishoarding of copper as a consequence of investor and industry fears of a recession. You're seeing the same thing in the oil and gas business. Inventories of oil, inventories of liquefied natural gas, inventories of gas in storage, and inventories of refined products are at historical lows. So you're seeing dishoarding because a lot of industrial and investment professionals, myself included, have a fear of recession.
Hmm.
Nobody who knows very much about copper is concerned, except for uncontrolled upsides, about the copper market 5 years hence. But a lot of us are afraid of the outlook in the 6 to 12 month time frame because a lot of us are afraid that we're overdue for a recession. I'm not saying it's a certainty, Antonio. When I look at the way the U.S. economy in particular has dealt with higher interest rates, I'm astonished by the strength in the U.S. economy. I mean, literally astonished. I'm afraid that the punch that has been thrown by higher interest rates to the economy will yield a delayed impact. But I'm not certain. But I really think that concern over copper is a short-term concern and is more related to concerns about a recession than anything else.
Hmm.
I'm not smart enough to tell you what is going on inside of China in terms of their loosening credit controls or ordering the banks to extend and pretend with regards to their existing bad loans and make new loans, some of which might turn out to be bad. What I can tell you, because I look, is that CITIC and Zijin and the various public-private parastatal organizations in China are spending literally billions of dollars to secure copper supplies, which tells me something about the way that the Chinese view the market 5 to 10 years out. And I share that point of view. No matter what we do today, Antonio, we will run into copper supply problems 5 years from now. You need to have made investments that would yield new production 15 or 20 years ago. And we haven't done it. The world's copper mines sadly look like me, which is to say past their prime, over the hill. Bingham Canyon, the biggest mine in North America, 150 years old. Chuquicamata, biggest mine in Chile, second biggest mine in Chile now, 110 years old. The Kids, Escondida, the biggest copper mine in the world, 40 years old. Grasberg, 50 years old. The world is living on deposits that are long of tooth and either at or past their prime. And the replacements are not lined up. If you look at the big new replacement in the United States, Resolution, was discovered 30 years ago. It's been in permitting for 25 years. It's likely to be in permitting for another 5 years. Then you have to build the damn thing. So when you look at the copper business 5 years from now, there is a very real risk that at least some of what Robert says comes true. What could go wrong with that thesis? Simple: recession. If you reduce demand, you can reduce supply and have no material impact on price. So when your listeners are considering the copper market, they need to consider at least two things, really three things. The first is that we have an inescapable supply problem coming up, and coming up reasonably rapidly. Will the market anticipate that? I don't know. We can obviate the near-term impact of this supply crisis with a recession. Will we have a recession? I don't know. The copper industry is a capital-intensive cyclical business and one that's prone to political risk. And when I say political risk, I'm not talking about Congolese political risk. I'm talking about taxation and regulation too. And that's something that your audience needs to be focused on. They need to be focused on the fact that in your lifetime, Antonio, not mine, your lifetime, the average mine grade of copper worldwide has fallen from 1.5% to less than 0.5%. These are what need to be considered. And to the extent that people want to invest in copper, at least in copper miners, they need to be less concerned about China and much more concerned about the micro around the copper company that they're thinking about investing in. I love the copper business. These tend to be very big, very long-lived mines. You tend to be able to buy them at discounts, big discounts. during periods of panic. There are any number of copper mines worldwide that generate $1 million in cash a day. Wonderful, big, fairly simple, long-lived businesses. So I like it, and I'm too old to be concerned about day-to-day, month-to-month price trends. I'm much more inclined to invest in things that have 3-year or 5-year probabilities where the odds are stacked decidedly in my favor.
When you said that the copper, at the beginning, you said the copper mines sort of look like you, I thought you meant that they look 40, 50 years old and looking like they can go another 50. Just to make,
that's very kind of you, but no, they're 70, and at best they have 20 productive years left. That's what the analogy is about, sadly.
No, I do understand what you're saying, and I'm having some thought, and it's kind of crazy because the more I think about it, a recession always makes me almost makes me more bullish on copper than it makes me bearish. What I mean by that is probably silly. You tell me if it is. What I mean by that is if the price of copper falls, then producers have even less incentive to bring on production. So it's just going to make it, it's just going to take longer, and that means a larger overshoot to the upside, basically. So it's almost as if it makes me more bullish that it's going to go down, if that makes sense, which sounds silly.
No, I don't think it's silly at all. I think if you look at the alternative use of capital, let's say that you have a choice. If your return bogey is the U.S. 1-year Treasury, let's say a 5% bogey, and you think that 5 years out, the copper price needs to be $4.50 or $5 a pound. But you understand that a recession could take the price of copper down and take copper stocks down in the interim. If you think about what a $5 copper price would do to the net present value of a copper producer 5 years from now, and you are prepared to hold that copper producer through the down cycle because your cost of funds is only 5%, and you are looking at a 5-year triple or quadruple or quintuple, yours is an extremely rational response. You're juxtaposing a 15, 16, or 17% annualized internal rate of return against a 5% cost of funds. It's just most people don't look at it that way. Most people get frantically concerned about holding stock over a long weekend, which is why most people lose.
You mentioned something else in your previous response, and that was that people should be concerned about the micro, so to say, their vehicles with which they're trying to play this trend. And this is also a challenge, though, because a recession might make me bullish on copper, but if the price falls over the short run and the tide, sinks all boats that have big holes in them, which is to say they don't have enough capital, not the ability to raise any capital when the price is going down, you're going to be hurt. And then I'm thinking about the higher quality companies, which we're talking about your friends today, apparently, so we can talk about the Lundins and what they're doing with the Vicuña district, right? You can say that's a high quality district. Is there a big discount there, though? Those are billion-dollar explorers and so on and so forth. So I'm having conflicting thoughts.
This is a wonderful discussion. Thank you. I didn't know that the interview was going to go this way.
I didn't know either.
The Lundins have been an unusually successful and unusually focused and pragmatic family, a family that thinks in decade-long terms. I've done business with the Lundins, 3 generations of Lundins now, since 1974. Adolf Lundin had an amazing sense as an example of political risk, which is to say it is where you find it. And he always thought in dynastic terms and in decade-long terms. What the Lundins are able to do in the Vicuña district is because they're Lundins, their cost of capital is fairly low. They can explore in a district where it's likely that they won't be able to put anything into production for 10 or 15 years at a reasonable cost of capital because they're honest people and they've delivered big deposits before. The challenges in Vicuña are obvious. You are operating in a political jurisdiction for whom nationalization and devaluation are spectator sports. They are operating at 4,000 meters, which is to say nosebleed country. They are operating in an area with no infrastructure whatsoever. The build in Vicuña is going to be a $5 billion or $6 billion build. What's interesting about it is they have two exploration and development stage companies, Philo and NGEx, both of which obviously have world scale discoveries. I mean, holes that are 1,000 meters in ore. You're talking Grasberg or Escondida style hyper deposits, but they're in a very tough place. What's interesting about the Lundins is if they are unable to sell those discoveries on terms that suit them, there is a different company, Lundin Mining, that has the financial and technical resources to develop these deposits when the time comes. It's sort of like the Lundins have the ability to have their cake and eat it too. They can spend money on exploration where the probability of a payback by way of a sale or development is at least a decade out. And they can do it with a reasonable cost of capital because of a 40-year track record of success. They can do it too because they know that if the industry doesn't have the courage to pay up for the deposit, that they can develop the deposit and monetize it themselves. An absolutely unique circumstance, in my view. Now, listen, disclosure, okay? I own NGEx. I own Philo. And I own Lundin. So if you're talking about talking your book, right, 3 strikes, I'm guilty. I'm talking my book for the reasons that I just described.
No, I get that point. And but also to the other point is they have access to capital and they have all that. They can sustain a possible recession. But does that mean all the other companies are off the table? Does that mean over the short run, be wary and be very focused on what you're doing and just stay away from most of them? Or I don't know.
I don't want to leave your viewers with a rule of thumb like that. The harder your viewers are prepared to work, the more they're prepared to understand the difference in movie parlance between the good, the bad, and the ugly, the more aggressive that they can afford to be. I've said before in interviews with you, Antonio, and by the way, you're getting to be a better and better interviewer from a pretty good start. Don't mean to flatter you, but take it. I've learned myself that the investments that I've made that have paid really good speculative returns, 10 for 1, 20 for 1, sometimes 50 for 1, have always required good people. I've never made big money with bad people, with one exception, but that doesn't matter. They have always taken a long time, 5 or 6 years. And they have always or almost always exposed me to a 50% share price decline during some part of the time that I've owned them. I guess what I'm trying to say is 10 baggers aren't easy. To the extent that people that listen to you are interested in 10 baggers, that they aren't interested in beta, they're interested in alpha. They are going to have to do the work so that when volatility shakes their faith, that they stay the course. So that when markets turn against them, they keep their eye on the prize. It's tough to own a big position in a stock that's down by 50%. It's tougher yet to understand that the value is so compelling that rather than sell when it's down 50%, you have to buy a bunch more. But if you're going to get rich as a speculator, and there's no reason to be a speculator if you're not trying to get rich, that's what you have to do.
You also have to have a low cost of capital. Like I don't imagine your average cost of capital on the Vicuña district is where the price is now. So you have to find them early, but you also have to have a reasonable expectation that they're going to have enough money to sustain and get to the point where they are.
it is important in the process of considering a company to determine whether or not they have cost of capital advantages and what their capital acquisition strategy is. At the same time, when you're looking at a mining company and you're asking about the strategy with regards to the beneficiation of their assets, the answering of the unanswered questions, to go back to the parlance that you and I used in interviews last year, junior companies have to have a capital acquisition strategy too. And I need to say, after watching the Lundins for 4 decades, their capital acquisition strategies have evolved and matured, but they've always had one. And it has been as varied as, having an interest in Pareto Securities, an investment bank, in effect, an in-house investment bank. But the durable competitive advantage that they have is performance and honesty. The other thing, of course, is that they eat their own cooking. If the Lundins go out to do a raise in Philo, let's say they go out to raise $100 million, which they just did, they put up the first 20 themselves.
Yeah.
That gives other participants, myself included, some confidence. It's not like their average cost is 25 cents and they're looting me at $15. Yes, they own some stock at 25 cents. And yes, they're putting in 20 million more at a much higher cost, much higher price.
If you can, someone said that during a dinner that I was at with investors. They said if you can take malice off the table in the early stages, that's a big advantage. And that was
how true that is.
Yeah,
how true that is. I wish I would have understood that at your age.
I hope I actually understand it, and I understand it with my money, because there's one thing understanding it in your head and actually understanding it with your money. Let's talk about the other side of that coin of copper, which is gold. Funnily enough, they seem to have gone in sort of a reverse correlation for a while, for about a year now, which is, you have the copper to gold ratio, which says if copper is going down, gold's going up, you're going to have some troubles in the market, because the market is always correct and always foresees these things. Gold is not having a great week either, testing the 1900 support and so on and so forth. Powell is out there being as birdish as he could be, hawkish, whatever bird they want to call it. He's saying he's going to raise interest rates. European banks or central banks are doing that. Swiss, Norway, whatever, the story. Bank of England surprise rate hike last week and so on and so forth. It doesn't look like it should be a good time for gold, because you've always told me gold has a good time when real interest rates are negative, and it doesn't look like it should be having a good time. But it's still relatively high, and if you look at it on a year-on-year basis, it's up. So talk to me about the other side of that coin.
Well, great discussion. Let's unpack that. I suggest that gold does well when people are concerned about the maintenance of purchasing power in conventionally denominated savings assets. And I think that people are much more confident now than they were 12 weeks ago. I think, too, that the increasing nominal interest rates, particularly in the United States, where you can get 5% on a 12-month treasury, means that gold has some competition that it didn't have 12 or 13 weeks ago. I personally believe that some measure of that confidence is misfounded. I have to say, I'm astonished, as I said earlier, by the strength in the U.S. economy. I'm astonished by real job shortages in both ends of the economy, in the service economy, where workers don't generate enough utility to get paid a living wage, but where there's millions of jobs on offer. In the trades, in manufacturing, where there are 5 million unfilled job vacancies in the U.S., and at the very, very top, the highly skilled sector, the highly compensated sector, where there's also an amazing labor shortage. The strength of the U.S. economy in the face of higher interest rates is very impressive. I don't know if it'll continue, but I think irrespective of that some of that confidence is misplaced for the following reasons. We believe, as a consequence of a 5% near-term treasury, that we are enjoying real yields. That assumes that the measure of inflation that we use, the measure of the deterioration of the purchasing power of the US dollar, is accurate. And I would suggest to you it isn't. The Congressional Budget Office still says that inflation is running at 6.2%. So if you assume that that's correct, and if you assume that the 5% interest rate or 4% interest rate that you're getting on bank accounts is achievable by most people. By the way, there's probably $1 trillion in the US deposited in accounts that pay no interest whatsoever for some reason that's inexplicable to me, but that's a sidebar too. You still have people that are experiencing a negative real yield. The negative real yield has fallen, but they're experiencing a negative real yield. The problem from my point of view comes down to the definition of inflation. Investors are ubiquitous in using the CPI, the Consumer Price Index, and confusing it with a cost of living index, which in fact it isn't. If you look at the deterioration of the purchasing power of the US dollar where people live, you see a very different story. First of all, core inflation excludes food and fuel. If you have some listeners who neither drive nor eat, that's a relevant measure of inflation, but I don't think you have any of those viewers. Probably more importantly, cost of living, that is the CPI as a measure of a cost of living, doesn't include the cost of government. It doesn't include tax. In the jurisdiction that you live, government, all forms of government, cost the average household 55% of their median income, which is to say that tax, direct and indirect, is a larger expense than shelter, food, energy, and transportation combined. If you look at the inflation of direct and indirect tax around the world, at least in major industrialized countries, and you don't include a tax calculation in your cost of living, if you don't take into account the deterioration in your after-tax purchasing power, you aren't using the right measure of inflation. When I look at US inflation in terms of the basket of goods and services that I buy, by the way, I'm a cheapskate, I don't buy much. When I add back tax, what I am seeing is a deterioration in my own personal purchasing power of about 8.5% compounded. And in that sense, I continue to be concerned about the deterioration of my savings. I look at a different part of the gold trade too. I look at the impact of interest rate volatility, but very low or negative real interest rates on the bond portfolios of major pension, profit sharing, and endowment investors worldwide. Imagine yourself, Antonio, maybe you can't, but try to imagine yourself as the portfolio manager for the Stanford University Endowment. You manage $32 billion, and your job is to manage the corpus of that estate for the benefit of the university and its students 20, 25 years from now. And 40% of your portfolio is in long bonds, very long bonds. You have two problems. The interest rate paid on your bond portfolio is less than prevailing interest rates are less than the prevailing interest rates at the time you bought the bonds. So the capitalized value of the distribution, the price of the bonds, has gone down. You need to deliver a 7.5% annual return to meet the spending expectations of your institution 20 years out, and you're down 20% on your bond portfolio. That is 40% of your portfolio has cost you 20% of capital rather than generated a 7.5% internal rate of return. And the purchasing power of the yield that you're getting on the bonds hasn't kept pace with the increase in costs that your institution is facing. You are between a rock and a hard spot. You have to disintermediate, which is a fancy way of saying sell and replace 40% of your 40% of your portfolio in a way that generates you a 7.5% internal rate of return. I would suggest to you that the realization of that conundrum for institutional investment managers is going to hurt the long bond market and it's going to help the gold market. I'm not saying that you, as the portfolio manager of the Stanford University Endowment, would take 40% of $30 billion, $12 billion, and put it all in gold. That's not what I'm suggesting at all. But I'm suggesting that you might allocate 2% of your portfolio to gold, which is 2% more than your current allocation.
So it's basically you're talking about the generalist investors going from being underinvested in gold or almost not invested to having at least something that could be a tailwind for it. And what do you think is going to wake them up? I mean, if the last couple of years haven't woken them up, you look at TLT, everybody's been losing money on it. They're still suggesting you buy it. So it's still not awoken. So I don't know.
I think, and we've discussed this in prior discussions that you and I have had, Antonio. I suspect that the perception of almost every investor on the planet, and for that matter, voters and savers too, has been shaped by the period 1982 to 2022, which was the most benign economic climate in the history of humankind. The interest rate fell, peace broke out, the baby boomers matured. I think that's over. The baby boomers are over mature now. They're consumers, not producers. The interest rates aren't falling. The interest rates are rising. Yeah. Rather than globalization and free trade, we're having balkanization and geopolitical challenges. I'm not trying to say that the world is going to a hell in a handbasket. I'm just saying it's becoming less benign. Our response is a response that was generated by 40 years of benign economic climate. We had nothing to worry about. You know, like the song, "Don't worry, be happy." I'm not saying don't be happy, but I'm saying you got to begin to worry. And beginning to worry, I'm not saying panic. I'm just saying think. I watched this complacency very early in my career. In fact, I was infected by it. Coming out of the 1950s and 1960s, which were also very benign economic climate. You know, we came out of World War II. We had the recovery of Japan, the recovery of Europe, the post-war baby boom in the United States. Pretty easy times, pretty mellow times. And then we ran into the 70s. That wasn't so much fun. In 1970, when I broke into the game, most investors couldn't spell gold. It had been price controlled. It was a 4-letter word. There was nothing to worry about anyway. You know, the people invested in the so-called Nifty 50, the stocks that could only go up, except they didn't. They went down. When we experienced the shakeout in the global economy and in American markets in the 1970s, we went from a period where nobody could spell gold to a period where in 1979, 1980, 1981, nobody could spell anything but gold. That's reflected, I think, today in the J.P. Morgan Chase study that suggested that precious metals and precious metals related assets constitute less than 0.5% of the savings and investment assets in the United States, down from a 4-decade mean of 2% and an estimated mean, because they didn't keep track of it then, in 1981 of between 6 and 7.5%. I'm not suggesting that gold is going to go back to 6.5 or 7%. I'm suggesting that it's going to go back to its 2-decade mean, which is 2%. And if I'm right, that means demand for precious metals and precious metals related assets quadruples. And that's what I think is going to happen. Do I think it's going to happen next month? Of course not. You have 40 years of schooling, which tells you buy the dips, don't worry, be happy. Biden was right. Merkel was right. Greta Thunberg was right. They're wrong.
They sure. It's kind of funny when you talk about sort of your generation, because it's almost like your parents and your grandparents went through massive pain, horrible times to
How true.
build what you enjoyed, and then you sort of over enjoyed it. And I'm just afraid that I might be the one paying for it, but I see you laughing, so I guess that's good. Uh,
Well, I'm laughing because if one of us has to experience pain, probably better you than me. I saw a really interesting statistic again about the United States, but the Europeans can take this to heart because your situation is probably a little worse even than ours. That is that the private wealth in the United States will be dropped down to future generations, at least some of it, net of tax, approximates $140 trillion. A lot of money, right? The on-balance sheet and off-balance sheet net present value of the obligations of the U.S. federal government, not including state and local governments, is somewhere between 122 and 130 trillion dollars. So the amount of private wealth that's left to pass from my generation to yours at $140 trillion in the US is consumed as to $130 trillion by our mutual obligations, which is to say we are preparing to leave you $10 trillion. And the $10 trillion that we're leaving you is substantially less on a net present value basis than was left to us. Which is to say, we have and we continue to eat your seed corn.
Forget about it. It's we owe the debt to ourselves nonetheless, so it doesn't matter, right? That's what economists tell me.
The spenders owe it to the savers. And in a democracy, spenders are substantially more numerous than savers. So one can reasonably expect them to vote to renege.
Sure, that's been working out too, socio-politically wise, but maybe that's a different discussion. There's a quote I heard on a podcast this week from one Harris Cuppy. He said something along the lines of investing is I think he said simple, or he might have said easy, but he meant simple, because he said you buy cheap assets with a strong fundamental tailwind over the long run, and you stay out of the way. He said it's been like that for 200 years, and it's going to be like that in the next 200 years. But when you come down to something like, I also saw a headline this week, something like uranium can offer shelter in times of recession. Well, which good, yeah. Well, nice, right? I guess so. Though my opinion is irrelevant here. I like sharing it. I agree with that. But then you can buy some cheap assets from, let's say, we are talking about your friends today. So let's talk about your former employer too, who is offering a cheap asset right now, but it's been at that discount to NAV for the longest while. I'm talking about the SPUT, the physical fund. So what happens if you buy something like that, where it's cheap, it has potential tailwinds, but is it gonna stay cheap? Like, it seems like it's been cheap forever and in a discount to NAV forever. So I guess that's a question on its own. But I'm just thinking, what is really cheap? I guess that's what
I think you answered your own question. What's cheap is patience. When you describe something as being simple but not easy, I think that statement answered your question. When you say forever, that product has existed under Sprott control for 3 years.
Yeah.
The uranium thesis is a 10-year thesis. So really, the discount that you talk about has existed for the blink of an eye. If you go back 3 years ago to when we first took over that product, we had days and days and days and days and days of that product selling at a premium, a substantial premium. We were able to monetize that premium with the normal course issuer bid. But I think if you examine the line of questioning that you've put me through, that you answered the question before you asked it. Buffett famously says that the market, among other things, is a mechanism for transferring wealth from impatient people to patient people. And I would suggest to you that after age 35, One of the primary reasons for my success is that I crossed the wall from impatient to patient. I feel sorry for people on the other side of the wall who persist in handing me money. But the other part of me is delighted that they exist. If I look at uranium and I see the incentive price necessary to maintain current production at 60 and the price necessary to increase production to reduce the deficit at 75, and I see myself with the ability to buy it at 55, I'm delighted with the ability to do that. There are other people who are less patient, who don't have any reason for their opinion. People who require a price rise to justify the narrative that they hope to come to believe, who will not do well in any market under any circumstances, with the sole exception of luck. And believing in luck is not an investment strategy.
That's a good point. Believing in luck is not an investment strategy. It's a good quote too. What do you think, to get more specific, maybe on the way that this Sprott physical fund works? Like, it's a wonderful idea, but what do you think about the way that it works with the discount to NAV that sort of exacerbates, big word for me, itself? What do you think about the working of the whole vehicle?
I think the vehicle is working spectacularly. Now, understand, I'm a Sprott shareholder. So the fact that, among other things, that's a $2.5 billion fee source for me is a wonderful circumstance. I'm also a shareholder. That is to say, I own the fund. It is very difficult for living, breathing human beings, even like myself, old, fat, and rich, fairly sophisticated. It's very difficult for me to go out and buy physical uranium myself and store it at Coverdine. And it's not something that you want to keep in your basement. So the vehicle that's available for me to play the uranium trade at its most basic, which is to say physical uranium, is the Sprott Physical Uranium Trust. And the fact that I can buy it at a discount, in other words, where I get a material that I already think is cheap for less, is, from my point of view, wonderful. I know that when sentiment changes, and I know it will, that same product will trade probably at a small premium, never a large premium, because if there's a large premium, Sprott will utilize the at-to-market financing facilities, monetize that premium, and buy more uranium with it. But that'll happen.
Do you think that's the way to do it? I mean, you're not necessarily steering the ship there, but is that how you would do it if you're running this vehicle, or you would take a different approach?
If the regulatory authorities would allow it, I would use the Sprott Physical Uranium Trust as a trader, which is to say, I would buy uranium at spot now, and I would sign long-term supply contracts at higher prices. I would use the capital in the Sprott Physical Uranium Trust to arbitrage the uranium market. Right now, the median sort of net price for uranium in the term market is $62 or $63 in change, plus an interest premium. And the ability to use the 60 million pounds that exist in the Sprott Physical Uranium Trust to sign medium-term supply contracts, 5 to 6 year supply contracts, and then fill those contracts in the spot market at $55. That's just a stupidly good arbitrage, but I'm not allowed to do it. I'm involved in a different product in a very small way, the Largo Physical Vanadium product, where we're able to do precisely that. We buy vanadium in that. We lease the vanadium in very large scale battery applications where it can be recycled. And rather than have to pay to store the vanadium, we get paid to lease it. My belief is that the vanadium price goes up, although I'm less certain about that than I am the uranium price. But I'm struck with the fact that ultimately, when that vehicle is of the right size, it should be able to pay a dividend while giving upside in the vanadium market and not charging investors fees. Since you asked me, that's what I would love to see in the Sprott Physical Uranium Trust. But regulatory authorities in both Canada and the United States didn't think that was as good an idea as I did, perhaps because they were influenced by the utility community or the trading community.
Then there's another political angle to that as well. Yeah. There's it seems to be new funds, new physical funds popping to market left and right.
Yep.
There seem to be allegedly, based on rumors, a few in the making. Some people are saying 4 physical funds in the making. Is that something you're interested in or looking at or taking into account?
I think it's silly. I think the new funds go to market. They have a 4% fee for capital acquisition. So in effect, they are buying uranium at 104% of spot when you can go to the incumbents, which is to say Sprott or the smaller incumbent, Yellowcake, and buy it at a discount. I guess new investors need to think, would I rather receive a discount or pay a premium? Now, they need to think long and hard about that. It's a very, very complex topic, you know. But I suspect that after hours of rumination, that somebody will decide that buying $1 for 92 cents is better than buying $1 for $1.04. I think that these new offerings will be successful making money because the structure of capital markets worldwide is that you incentivize good salesmen to cause people's greed to overwhelm their common sense, which is to say, I think they'll raise the money. And I think that they will further tighten the uranium market. It is comical to me that newcomers are able to raise money at 104 or 105% of par when there are much bigger incumbents with structural advantages that are selling at a discount. But that's the way the world works. Markets are always right in the very long term, and they're always wrong in the current term.
Which is where I guess the opportunity comes for speculators who are willing to do the work. So,
or even just think, this isn't a hard question. Would you rather pay a premium or receive a discount? This is not rocket science.
Yeah. Well, sometimes some brands have tried to do to play around that and make people pay a premium so that they can feel they're getting a better product. I don't think that's the case here, but I get your point. I'm about to let you go here because I know they have to go in a couple of minutes. Just one last thing, and to end it sort of on a light note, in a completely different topic. But in recent weeks, I've been reporting on all sorts of crazy developments and technologies in the natural resource space, like asteroid mining and deep sea mining. But this week I read this title, this article. I didn't read the whole article. I don't think that said something like NASA is looking to mine the moon, of all things. Build some sort of a space station around it first, and then a space station on the moon, and then do some weird stuff to the works, and then in a couple of years, they're looking to send a drill this year, actually, and they want to start the works by 2032, which surprisingly might be before some uranium deposits come in production. But what do you make of all these things? Deep sea mining, asteroids, moons?
There's only 2 explanations. Only governments or people who can loot governments are able to conjure up a net present value in something like sending a drilling rig to the moon. The only reason, I guess, that an intelligent government official might even consider that is because that government official is aware of the obstruction that their own institution puts in place to exploiting resources on Earth. At the same time, they see the need to send a drill rig to the moon. They take a deposit like Resolution, the copper deposit in Arizona, which is over 1 billion tons of 1.5% copper, 3 times the average mine grade worldwide. And they tie it up in a regulatory morass for 25 years. So perhaps if you're a government official and you understand the treasonous nature of what it is that you do, You think that the net present value of something that isn't going to work for 100 years is higher than the net present value of something that you're going to obfuscate right now. It's the only explanation I can come up with.
Well, I made a comment on Twitter today, and it's not my comment. I stole it from somebody else who told me that in an interview, and it's short. It's just 4 words, and I said, "Not with my money." So.
But yes, with your money, because you're a taxpayer. You say not with your money. What you say is not with your money without coercion.
Exactly.
But it is with your money.
It's with money that used to be mine but got stolen from me legally.
That's correct.
So
that's correct.
Rick, it was a great talk. You are going to be in Florida soon, so tell me about that.
I am. We have our annual Natural Resources Investment Symposium coming up in Boca Raton, Florida. I'm told this is the 23rd year that it's existed under my stewardship. It existed under the stewardship of Agora Publishing before that. So the first thing I want to say is it stood the test of time. I want to say that this is going to be, I think, all humility aside, the finest natural resource conference that will occur this year. I say that with some confidence, frankly. For those of your listeners who can and would like to come to Boca Raton, July 23rd through 27th, act now before the prices go up. The prices go up in 3 days. For the much more likely circumstance that your European audience would like to go to the conference but would like to do so from Europe, we're live streaming the conference. In either case, there will be 50 hours of programming in 4 days. You will have access to the conference tape for 6 months, and you'll have to use it because 50 hours of straight programming is more than anybody, even myself, can endure. Importantly, we have wonderful big picture thinkers, but big picture in a way that you don't get from mainstream media. The Daniela DiMartino Booths, the Nomi Prinzes, the Jim Rickards, the Bill Bonners, people who have a worldview that is valuable and rare. More importantly than that, probably, if you agree with that worldview, we have analysts and portfolio managers who didn't come to natural resources because they flunked out of crypto or pot. They're people who have existed profitably through decades, 3 decades of thick and thin. More importantly than that, we have a club, if you will, called the Living Legends, people who built multi-billion-dollar natural resource companies from scratch. The lessons that they can teach as a consequence of that to investors are invaluable. Our exhibitors are content too. They're not just advertisers. Every public company exhibitor at the conference is owned by the presenters and directors of the conference. Now, sadly, Antonio, not every stock I buy goes up. But you can count on the fact that if somebody's an exhibitor at my conference, I have studied them well enough to invest my own money in it. And that leads me to the last reason. Anybody who comes to my conference or buys any of my educational products ever has a gold-plated money-back guarantee. If you attend the conference physically or virtually and you think for any reason at all, I didn't deliver sufficient value, email me and I'll give you your money back.
Are you having to give a lot of money back? I think you told me that's not the case.
Over 30 years in developing financial education products, I've had to refund a little less than 0.1% of revenues. That comes from the fact that we've paid an awful lot of attention to content.
Good point. Good stuff. Rick, this was a great discussion. It was way longer than I intended it to. I hope I didn't overstay my welcome, but I did enjoy speaking to you. So thank you so much for investing your time in me.
Always a pleasure. Thank you for this interview. And thank you for the interview that you did with me on central bank digital currencies, too. I replayed that interview this morning in preparation for this interview. And it was actually, I think, a wonderful discussion.
Yeah, I thought so, too. You said that they are worse than cancer. So that stuck with a lot of people, I believe.
I had them bracketed as worse than cancer, but better than nuclear war, which is really where I think they fit.
All right, Drake. Thanks so much.
Thank you.
All right. I know that, and my forehead is super shiny for some reason, but I know that most of you won't actually click and like go and watch another video. It's too much of an ask, I know. Even if it's specifically the one at which Rick Rowe talked about de-dollarization, the banking crisis, and CBDC. But I mean, I made the unthinkable effort here to cut that part of the conversation and insert it in this video so you can just keep watching. You don't have to click away. But yeah, here's what Rick was referring to just now when he was talking about CBDCs. I wanted to get your thoughts on it, but yeah, maybe you can talk to me about that. I mean, in a more down-to-earth way, as you always do, CBDC and de-dollarization. What do you make of that? Where does that fit in your view of the world?
Very different discussions. The first one, CBDC, is, other than nuclear war, probably the scariest concept I've ever been introduced to. The idea that the central bankers, who I think have already wrought untold damage to the citizenry, are prepared to control the currency absolutely is horrifying. Think about the conjunction of social credit scores, which the Chinese do actively now, with artificial intelligence and a medium of exchange that isn't yours. You license it from a bank, or rather from your government. Your government doesn't like the way you voted, so they cancel your savings. If you held euros in cash, or you held gold or silver, the government could dislike your views with regards to COVID, or with regards to socialism, or with regards to energy policy, and it wouldn't matter. In the central bank digital currency world, if they don't like your views, they cancel your savings. They cancel your medium of exchange. They cancel your store of value. You made money by providing a good or a service to another individual who valued the good or service that you sold him or her more than they valued some portion of their savings. Your government then prepares to cancel the work that you did, that delivered the value, that made your savings, because they don't agree with your view on their policies. What that means is that they've made you a slave. Their slave. You've made contributions to society, and they have stolen your compensation for the contribution that you made to society because you disagree with them. Central bank digital currency could drive me to the gun. Pretty clear?
Yeah. I wouldn't have expected to hear that from you. But it does. Yeah.
It's absolutely terrifying. You know my view with regards to the big thinkers. Most of them came allegedly from good families and went to good schools. Had that not been the case, I suspect with their morality, most of them would wear masks when they went to a convenience store. And the idea that they would exercise more control over me than they otherwise do, particularly the ability to consign me retroactively to slavery, is not something that I regard with any particular favor. De-dollarization is something different. I need to start by saying that the big enemies of the world, of the US dollar, pardon me, are not China or Russia or Saudi Arabia or South Africa. They're Congress. The United States government is inadvertently declaring war on its own currency, weaponizing the currency, using the currency as an instrument of US social policy, suggesting that other peoples, other societies, other countries around the world need the export of US social and political mores in a way that allows the US government to weaponize the currency. The interference in the SWIFT banking system, which is a global, not an American system, is more responsible than anything else for the decline in popularity of the US dollars. It's difficult to understand why the Chinese or the Russians or anybody else would want to assign seigniorage, assign what Charles de Gaulle described as the exorbitant privilege of being able to print out of thin air the world's reserve currency. But why the American citizenry would allow their Congress to debase the franchise of the US dollar is beyond me. And then you need to look at the arithmetic around the US dollar. you need to decide whether, as an example, the $200 billion that were added to the U.S. banking system a couple months ago, without any increase in taxation, any increase in borrowing, which is to say $200 billion that were conjured up, counterfeited, quantitatively eased. How does that benefit the stock of existing dollars? How do foreign creditors feel about lending the United States money, getting paid 3.5% in a currency that's devaluing by 7% in terms of purchasing power, while at the same time enduring hostile action and criticism from the U.S. government? It's odd to me that despite the best efforts of the U.S. government to destroy the U.S. currency, the U.S. currency is defeating them. It has been said by Doug Casey that the U.S. dollar is an I owe you nothing, while the euro is a who owes you nothing. 16 or 17 host governments, each with their own idiotic internal economic policy. And the BRICS, well, the BRICS are a bunch of debtors who owe you nothing. So despite the fact that the U.S. government is doing its best possible job to devalue the dollar is still the beneficiary of the most transparent economic system in the world and the deepest and most liquid financial system in the world. Most debts worldwide are denominated in U.S. dollars, so there will be ongoing demand for dollars simply, if for no other reason, to service the existing debts. Mm-hmm. And while it is true that the U.S. has earned the distrust of nations around the world, ironically, they still trust us more than they trust each other. Hmm. So I think that de-dollarization is something that might occur in your lifetime, but it won't in mine. I think the U.S. dollar will be less important over time because the market share of the U.S. economy relative to other economies in the world will necessarily decline as other countries do better. The United States, as an example, has 22% of the world's savings and investment assets. My suspicion is that 30 years from now, however long it is before I shed my mortal coil, that our market share will be something like 17%. Not necessarily because of the decline of the United States, but rather because of the rise of other places. The consequence of that is that other currencies will have larger floats, more volume, and hopefully be more transparent. May occur, may not occur. But de-dollarization, I think it's a benefit to the world, frankly. I think a multicultural world, a multilateral world is always safer than a unicultural world, even if that uniculture allegedly represents me, which, as you can gather, it doesn't. I view ongoing de-dollarization as a good thing for the world. I view central bank digital currency as being substantially worse than cancer.
That's well said. It sounds to me like you're saying that the dollar is sort of the worst currency besides all the other ones.
All the others, that's correct.
Yeah. Winston Churchill would agree. All right, so central bank digital cancers aside, in the off chance that someone did want to watch the previous interview or previous couple of interviews, I'll put a link somewhere to maybe the whole Rickroll playlist. I've interviewed the man like 10 times, maybe even more. And if you want early access to content like this for free, visit resourcetalks.com, where you will find a chat community of natural resource investors where I share such interviews in advance. And I also announce guests in advance, so you have a chance to get your own questions through and sort of dictate the topics that are discussed in these podcasts. Other than that, thank you for watching, listening, or dropping your phone in a ditch while an interesting video was playing, and this was just next in row. And if you choose not to subscribe to this channel, which is, of course, the wrong choice, I wish you good luck, and until the algorithm gods connect us again, stay safe out there.